In times of market turbulence and market economic uncertainty, where do wealthy people go to risk adjust and hedge their assets? Making money is a skill set. We all go to school, we get some kind of training, education, some background, certificates, licensure, whatever it might be, and go either build a career with a company or we might build our own business or professional practice. That's a skill set. And working on that skill set to create an income and stability in life is really the American dream. And do it as you wish and be as prudent as you can about how you build that lifestyle, right? The other side is how do we buy back time, and how do we actually keep money that we've made trading time for dollars? How do we keep it and preserve it for the future? Preservation is probably more important today than it ever has been in, I'd say, at least 15 years in time retrospect. Why? We've had this great bull run market because there's been a lot of stimulus, a lot of debt that's produced the results that many in the upper 20% tranche of Americans, those who own assets, either financial assets in investments or own businesses, real estate, you name it, stocks. It's been an uphill ride all the way, and the tailwinds pushing that have been very dramatic. This is not sustainable. No market is ever sustainable beyond a certain period of time, and eventually the market's correct. There's a term called reversion to the mean. Everything that goes up, particularly those things that go up at a higher degree angle, more parabolic, the drop back down to reversion to the mean is typically as steep or steeper when it happens. Now, no one can predict when it happens. My point is, we have a lot of exuberance and euphoria in the marketplace. Many, many people, particularly those who are maybe a little bit younger in life, haven't gone through a full cycle. If I mention the 2008 great financial crisis, a lot of people don't really have much memory of it. Maybe they were in school, maybe their parents talked about it, but it's not a reality to a lot of people. Even those who went through it, I find today, have lost a lot of the concept. Their memory is very short term, forgetting that there was tough times back in 2008. And we can go be to a time before that, the dot-com, the tech bubble that burst back in the early 2000s. And I can go back further and further and talk about every time that people thought this time is different and something new has changed the market cycle dynamics and assets, and the markets only go up. Been fooled every time. So it's not a matter of not riding the markets. We should take what the market gives us, whatever sectors you like to invest in, your businesses or financial markets or alternative assets, wherever it is. If you've had a great experience and great returns in those areas, that's wonderful. There comes a time, though, when someone needs to take chips off the table, right? Meaning harvest those equities. Because in most cases, the returns that we receive in equities are just on paper. They feel good to us because we can look at the numbers and go, I have this much net worth. But net worth is only as valuable as it is in your hands. And what I mean by that is what does that net worth produce? It's great to accumulate and grow it when the market allows for that. My point is, how and when do you convert that net worth, those paper gains, into something that's a little more hedged and can produce at the right time the predictable, more certain, even-keeled income replacement that's all about buying back time. Those are the provocations that people face today. In the specific arena that I've always loved, and I go back over 40 years involving myself in real estate, first as a very hands-on investor. I had more time than money, and that was the way to go. And I built up a considerable portfolio of equity and then therefore income derived from that equity that allowed me to have freedom of time, freedom to escape the chair from my professional practice when I needed to with my family. It worked. It was a compound effect over time during a time period when the markets were kind to me in my model, and that was wonderful. Today, I don't want to be as active in actually hands-on. I appreciate my time much more today because time is a commodity that I can't buy back. I can buy time today by not feeling like I have to do everything myself, and that means utilizing other people and other platforms to invest my money. My point is, where do you put capital that you've already got the paper gains? Where do you shift? Most people say, well, I don't want to shift. I want to just keep riding the market up. The problem is the market won't keep going up. Eventually, the market's going to correct, and all these paper gains can be decimated very quickly. It's happened over and over again. So not timing the market, but moving and hedging your risk is what you've got to do. In real estate, As I said, I built everything on equities, and equities is all about growth. It's leverage. It's the opportunity to really maximize one's ability to grow that wealth. But to do that, you've got to be really hands-on to make that happen. Again, I don't want to be hands-on today. I don't see a lot of great growth opportunities today. Well, for instance, Warren Buffett doesn't either. Warren Buffett is sitting on more cash in short-term treasuries than he ever has in the past. Like $325 billion he's sitting on. Why? Is because Warren is getting lazy? It's because Warren doesn't know what to do? No, Warren has the experience of decades in looking at the market today and saying the market overall in most asset classes, most companies, most businesses, most equities, it's way too high. He knows that we're due for a correction. He knows it's better to sit on some liquid, risk-off cash for the near term and wait. That's hard to do. It's hard for anybody to do, particularly when we still see the run-ups in the financial sector. It's not going to last. So where do I go in my real estate investing? That's where I focus. You could do this in any other sector, but where do you go? I like to go to the private credit side. That's what I call being the bank. When I'm looking at potentially investing money with somebody, because again, I don't want to be the operator anymore. So let's say I've got an operator. He's got a great real estate opportunity. Says, David, would you like to go in on this with me? And typically that would be in days past or years past when the market was still going up. Yeah, I'd go on in some equity basis. Now remember, equity means ownership. And when you're investing in equity, there's no certainty of what the returns are going to be. You get what the operation and the market provides. And if the market's going up and the operator is good, then there's this upside, which is what we love. But what if I feel like right now is not the right time to be in equities because I don't see the growth? I see more risk, and I do today. I see more risk in the equities overall, whether it's the stock market, tech stocks, real estate. I see more danger, more risk, and less opportunities. Just like Warren Buffett, I see less opportunities to buy in right now. So what do? I shifted a lot to the private credit or being the bank side. If my same friend says, David, do you want to go in on this real estate deal? And I say, it looks a little risky right now. How about if I just lend you some money to help you with this, and I don't take an equity position, partnership, if you will, with you. I'll just lend you money, which means you're going to agree to pay me back a certain contractual is the key word, return on the money I lend you. And again, that's negotiable, whatever that might be. Whatever I feel like is commensurate with where I could put other money and whatever makes sense for this particular operator. But that puts me in a position where I get what's called first money out. I'm going to get my money paid back to me as the lender, the private credit lender, before the operator who owns the equity gets their money out. That's just the way it works in life. And again, there's times to be in equities, but there's also times to take a lower risk profile and take something that's more certain. And because life is always about trade-offs. There's never a one way to do things. A lot of it depends upon where we are in the market cycle, depends on where you are in your life cycle and career, and what your allocations look like, and how much risk you can afford to take based on where you are in your life cycle. These are all the kinds of permutations and deep dive questions that we derive from our members when we do our member Blueprint Weekends in Freedom Founders. This is the deep dive. Most people come with a lot of assets, a lot of hard work that went into it, and now they're trying to figure out how do I manage and navigate these assets, where we are in the market cycle, and based on their goals and timeline. Maybe they want to start taking more time off, which is, I think, always a good thing. Many don't take time off because they feel guilty and they feel uncertain about how much is enough. Because yes, we have inflation rearing its ugly head after 40 years of very nominal inflation for the first time ever, and I think we're going to see more of that. We're going to see more volatility in the marketplace. We're not going to have these big long run-ups where the markets go up, 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 up with a moderate recession. I think it's going to be up, down, up, down, up, down, and that's going to shake the markets a lot. Understanding how to more actively manage your assets outside of your primary business, the trading time for dollars, the technical skills that you learn how to do and can certainly make you money. But when you want to turn a corner and create more passive income where you don't have to be in the management aspects of it day in, day out, this is where it requires more discernment, more education, it requires a network access, because I like the private side, alternative assets, overall more favorably than I like the public side. Nothing wrong with having money in both sectors, public being stock market, stocks, bonds, mutual funds, ETFs. Nothing wrong with that. It's certainly a more liquid market. It's meaning you can put your money in and get your money back out. But that liquidity also creates what? More volatility. So deciding what your allocations need to be between public markets and private or alternative assets is one of the key concepts. And most people don't have any experience in alternative assets. And so they feel like they can't do anything. Well, it's a whole market that's growing by leaps and bounds today But learning more about that, how you can have more diversification in your allocations, I think is a critical part for anybody who wants to have longevity and generational wealth transfer in the years ahead. Again, preserving and maintaining your purchasing power of your money is going to be one of the most critical skill sets that one can learn. It's not something you can just abdicate, put your head in the sand, and say, someone else will take care of it for me. Those days are over. It's up to you to create and maintain your freedom, your goals, and more importantly, how do you buy back your time? When do you do it? How do you do it? With whom do you do it? These are the key elements that we do a deep dive in Freedom Founders on a daily, weekly basis, and I love doing it. It's so much fun. I've been down the road. I've mined my own experience and the experience of hundreds of others. I can see the writing on the wall and help people discover what they're missing in their life. Where are you in that process? What's going to be different for you in 2025 if you don't make some substantial changes today?